All right, so here's our itinerary for today. First of all, I will explain why we look at charts, why they're valuable, try to give you some insight into how charts can help you become a better investor. And then we're going to get into the theory that I've developed for reading chart patterns so that we can get to the point where with some practice, you can look at any stock, any market, and within a few seconds, determine whether it's something worth considering or whether it is something worth avoiding, or under what circumstances you would buy or sell or short that market or stock. And from the inflection points, we then have our building blocks for understanding what I call the 6 elements of chart patterns. So I'm going to teach you what those 6 elements of chart patterns are, and then we will put them together so that we can analyze some charts together. Thank you for someone letting me know that my slides weren't changing. You should see it change in just a moment. There we go. All right, so there you can see the itinerary for today. Thanks to William for letting me know about that. So anyway, we're going to teach the 6 elements of chart patterns. We're going to show how they work together. I'll then talk time frame confirmation, which is a very important concept that we need to keep in mind as we are making decisions. What that means, I'll explain it and how to use it. I'll show you the Stockscores Education Center, which is an online school, I guess, where you can learn more if you want to take your education beyond what I talk about today and get into the specific strategies that I use on a daily basis for playing the stock market. I'll talk very quickly about the live classes that I have coming up in June. And then finally, I'll analyze some stocks for you. We'll analyze the market overall. I'll show you where you can get my weekly market analysis for free. And I'll take a few stock questions. I won't do a lot of them, but if you have a stock that you want my insight into, I can give you those that analysis using what I'm teaching you today. And it'll be a good way to sort of wrap up what we're talking about today. All right, and hopefully everyone's ready. We've got a big crowd in here today. Thanks everyone for joining. And let's get right to it. All right, so why charts? Well, when I started trading, and as I said, I started trading 26 years ago, I really did all of my trading based on the fundamentals, the story of the company, what they had good, what they had bad, that sort of thing. And I was a student in the University of Calgary studying finance, doing basically what my professors were telling me to do. What I found was that no matter how much analysis I didn't have the best information, that there always seemed to be someone who heard about things or knew things before I got it. And, over time it got a little frustrating because I would, learn about a stock that had a great story. Maybe it was a mining company that had discovered a big deposit. But when I looked at the stock, it had already gone up significantly by the time I heard about that information. And so what I recognized is that I needed a better way. I needed to either be an insider and get inside information so that I could learn about these things earlier, or I needed to come up with an approach to trading that would allow me to find these things early. So when you look at a stock chart, what you're really looking at is a graphical representation of what people know about a company and what they believe will happen in the future. And as I go into the presentation today, I will show you and I'll explain, when I'm drawing lines on a chart, what those lines actually represent in terms of the actions of people. But not only people, also computers, because computers represent about half the volume in the stock market today. And so we need to understand that we're not just trading with other people in the market, we're also trading with computers, and computers have been designed to take advantage of the humans. And you have to recognize and understand that, and that's another way that charts really have a positive effect on your performance, because they not only reflect the opinion of millions of people, but also the computers. The nice thing about charts is that it's simple to do. If you can draw a straight line with a ruler, you'll be able to do what I teach you today. It's quick. You can analyze a stock very quickly. That's the whole purpose of today's presentation. I'm going to show you how to analyze a stock very quickly. And ultimately, because the market prices in information before the information is disclosed in a news release, using charts can really give you an edge to beat the market. And that will make a little more sense as we go through the discussion. So first of all, let's talk about stock charts. What is a stock chart? I'm going to assume that some of you here today have never really done any chart analysis. You have no idea what a stock chart is, what it represents, so let me explain. So this is a chart of the S&P 500 ETF, and it is a 3-year weekly chart. That means that each one of these bars, which we call candles, represents the price movement over the course of a single week. So in this case, the one that I've circled, at the start of the week, the stock was at just a little under $170 a share. And by the end of the week, the S&P 500 ETF had risen to just under $175 a share. Now you're probably saying, well, why are some of these candles red and some of them green? The color represents where the stock closed for the week relative to where it opened. So in this case, the stock opened the week at 169 and it closed the week at 174. Okay? Now when you have a red one like this, it means that it closed below where it opened that week. So in this particular week, we opened at maybe 198 and we closed the week at 193 or so. All right, so that's the difference in the color. Now, if you're not seeing any charts or anything changing, then you've got some issue with your login to this webinar. I am recording today's webinar, so if you do have technical problems where you can't see the images, the first thing I would suggest is try logging out and back in again. That often fixes the problem. If that does not fix the problem, I will be emailing you a link to this video. It'll be put up on YouTube so that you can watch it later. And I apologize if you're having problems. Unfortunately, you know, every time I do a webinar, I've got 2 or 3 people that don't see what I am discussing. All right. All right. So anyway, where was I? Oh, I was explaining the colors of these charts. Now I'm going to erase these lines here. I've got a little tool that I can erase what I'm talking about. The next thing I want you to understand is that this is basically how price changes over time. So right back here, that's April of 2013. The stock went up for a while. I shouldn't say stock. This isn't actually an exchange traded fund. And over here is where we are right now at the end of April 2016 into May. And the market has obviously come quite a long way in that time, in the last 3 years. All right. The price action is in the top part of the chart, and the volume is the middle part of the chart. So in the case of this particular week right here, the ETF representing the S&P 500 traded 1.5 billion shares for the week. Obviously a very dramatic week. That was when we had the sharp sell-off last summer, last August into September. And that's it. All right, so that's a basic overview of charts. You'll probably also see here my third chart, which is the Stockscores chart. This is my own indicator that I've developed to help people know when to get into a stock or when to avoid it. It's a simple way of analyzing the market using an algorithm that I wrote. And the basic rule is we don't want to consider ownership of a stock unless it's got its sentiment stock score above 60, which it had through this uptrend. Notice when the stock started going down over here, that's when our stock scores dropped below that critical point, as it did here when we had this loss. So it's a nice, useful indicator. It's kind of the first cut. It's basically an algorithm that I wrote that says, if stocks are going down, let's avoid them. And if they start to show optimism and are going up, let's consider them. And we had a good period when the market was above 60, and that's the rally that we had since February. All right, so I got so many lines on the chart. Let me just switch to another chart because I also want to show how you can look at the same or use the same concept when you're looking at a much shorter term time frame. This is a chart of an ETF that goes up when the gold mining stocks go down. The symbol is dust. Okay, it's one that I traded last week. And so when the gold mining stocks go down, which they did at the start of last week, this goes up. And you can see here, it went up on the 2nd of May. That was starting Monday. It was at $1.30. Whoops. It was at $1.30 right there. I bought it, I think, at $1.36, and it did a nice little 2-day run. So if you're a shorter term trader, which is what I tend to do more than anything, you can use this kind of analysis to get in and out of stocks in not only a couple of days, but sometimes even a couple of hours. The first chart that I show, this is that long-term time frame for the investor, for someone that wants to buy something to hold for the next number of months or perhaps even years. This chart is what a swing trader would use. That's someone that's holding a stock for a few days. And then finally, we have a day trader chart that someone would use if they're going to move in and out. That would be a 2-minute time frame, and you sort of trade very actively as a day trader, always out by the end of the day. All right, so those are the 3 styles of trading and 2 different types of charts that we've looked at. Okay, so that's your introduction to charts. And if you want more information on charts, certainly if you do some Google searches, you can find out some basic information on how to look at charts. What I'm going to do now is teach you my method for analyzing charts. Now, technical analysis has been around a long time. In fact, it's been around hundreds and hundreds of years. The Japanese used technical analysis of price to trade spice and different commodities. And they're the ones who really started stock charts, or not stock charts, but charting of prices, as I said, hundreds of years ago. More recently, I suppose, people have been charting stock price since the market began. When I started trading, the internet wasn't really popular yet, or well known, and you couldn't just log into a website and look at stock charts. When I started trading, I used to draw charts out by hand. I would flip through the newspaper looking at the price of the stocks I was interested in, and on graph paper I would make a little notation of where stock price was changing over time, and that's how I started doing stock charts. Now, of course, it's very simple. You can go to websites like mine, stock charts, or stockscores.com, and you can pull up the chart for any stock, and we'll do that later together. All right, so what I'm going to teach you now is the building block of chart analysis. I would say that most people that do technical analysis make it way too complicated. And what I want to do is really simplify it, because simple things work the best, right? Now, as I said, I've been trading a long time. I've been teaching people how to do this for 16 years. And over the years, I've just tried to always try to make it more and more simple. So if you saw one of my presentations, 10 years ago, and you compared that to what I'm doing today, today is much simpler than it used to be. And it's because I've got a better understanding of it and come to realize that the simplest things work the best. So what is the simplest thing? It is the inflection point concept. These are the building blocks of chart analysis. They are the peaks and valleys on the chart. It's where stock price changes direction. So if we have time along the horizontal axis, and we have price along the vertical axis, call that dollars. This is time. So as time passes, price changes up and down, right? And I might do something like this, and I'm just drawing a very simple chart showing how price might change over time. Now, you can see in the chart that I've drawn that I have all these little peaks and valleys. So here's some of the peaks, and then we have the valleys where the stock stopped going down and started going up. So the peaks and the valleys are the inflection point. It's where price either stopped going up and started going down, or stopped going down and started going up. And you can see how it's changing over time. Price goes down, stops going down, starts going up. We have an inflection point low. We have an inflection point high. Now, these are important because we're going to use them to draw lines and define what people are doing in the market. So let me begin with this chart. This is a chart of Kinross. It's a Canadian gold mining company listed on the Toronto Stock Exchange. You can see the symbol up there. For Stockscores, you always have to put a T dot in front of a Toronto Stock Exchange symbol. And if it's on the TSX Venture, you have to put a V dot. For US symbols, we just enter in the symbol. So Microsoft just gets entered as Microsoft, MSFT. So in this case, we got T.K trading on the Toronto market. Kinross, the symbol is K. But at this point, I don't want you to worry about analyzing this chart at all. I just want you to look and figure out where the peaks and valleys are on this chart. So just ponder that for a second. Where are the tops and the bottoms? The places where price stopped going down and started going up, or stopped going down and started going up. Did I just say that? Stop going up, start going down, or stop going up. I don't know. You know what I'm trying to get. I'm mixing myself up. All right, so there is a little inflection point low. Here is an inflection point high, low, high, low, high. There's a low point. There's a high point, low point. As time passes, we can sort of highlight these little tops and bottoms that occur over time. Now those inflection points have meaning because it's a point where price changes control from either buyers to sellers or sellers to buyers. Now just a little bit of a quick explanation of what's going on in the market every day. You've got people buying and selling. If there's a buyer, there's also a seller. If there's a seller, there's also a buyer. There always has to be two people being matched up to make a trade. So if you want to buy 1,000 shares of Kinross, you have to pay the price that someone is willing to sell 1,000 shares of Kinross for at that particular moment. So always keep in mind that for every trade, there's a buyer and a seller. If the buyers are stronger and more motivated, then it stands to reason that price will go up over time, right? So you can see here the stock kind of bottomed out at $2, and then the buyers found some motivation, and they started sending price up, 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 until it hit 450 or so, and then it stopped going up and it went down or a little bit sideways for a while. So this was a change of control. The buyers were in control here, and then they kind of lost control, and the sellers took control for a little while. The sellers were in control here because price was moving down. The buyers were really in control there because price was moving up. So the inflection points are where control changes. The stock is going up, it stops going up, it starts going down. The stock is going down, it stops going down and starts going up, change of control. All right, so that's the inflection points on Kinross on that time frame, but we can also look at it on a weekly time frame. So if you're more of a longer term investor, then you're probably going to consider the weekly chart as opposed to the daily chart. But it's the same concept. Where are the inflection points? Well, I'm just going to highlight the little tops and bottoms on this chart, highs and lows. Where does control of the market change as time passes? There's your tops and your bottoms. I have a downward trend line, which we'll talk about in a moment, which cuts across those inflection points. And that's why inflection points are important. Okay, so to this point, all you need to understand is that we have little peaks and valleys on the chart, and you need to be able to see them. Once you see them, then you can start to see the 6 elements of chart patterns. They are support, resistance, optimism, pessimism, price volatility, and abnormal activity. And we're going to learn how to plot those things on a chart using inflection points. So let's start with support and resistance. Support is a floor price. If we find an inflection point low, like this one right here, we can say that is a line of support. It's where price stopped going down and started going up. What does it represent? Well, here the sellers were pushing price down, right? And it got down to $2. And then the sellers said, well, you know what? I'm not willing to accept less than $2 a share for this company. I think that that's cheap enough. And so price stopped going down and started going up. Now, what made them do that? Well, you've got investors who every day in the market are analyzing the fundamentals, you know, the company's story. In this case, it's a mining company, so the price of gold is very important. Management, what their properties are, whether they're finding new discoveries of gold. That's the fundamentals, right? And all of those things have some value. And the job of the stock market is to figure out what that value is. And price stops going down when it reaches a price where people say, well, this company is worth more fundamentally than what we're letting it sell for. And that's why we call it a support price. It's a floor price that is held up. In this case, it's held up for 1, 2, 3, 4, 5 months. So for 5 months, this stock did not trade below $2 a share. And it's quite meaningful that when the stock was selling down here, that it got to the floor price that was set back in September and it didn't go any lower, because the market remembers old floor prices. They remember that in the past they were never willing to accept less than $2 a share. And so that has meaning. And one of the ways that you can trade this concept of support is to look for stocks that are falling into a historical low price, because there is a good chance that they will bounce back when they hit that price. And I did a trade on Apple starting Friday 2 weeks ago and continued to add to it on Monday. That was based on this concept. Apple was moving down sharply and it got to a floor price that it had set a couple of months prior, and I felt like it would probably bounce there. And I bought Apple basically 18 cents off of the low that it hit, and 2 days later, maybe 3 days later, I sold it for a nice quick profit using this simple concept of support. All right. So now let's talk about resistance. Resistance is the exact opposite. It is a ceiling price. It is the maximum price that people have been willing to pay in the past. So here we have an inflection point top. We can draw a horizontal line at that top and see that the stock traded underneath that resistance level for a while. It also had support. It had support at 375. It had resistance at 450, and it stuck inside that range for a month and a half. So the market was saying that they didn't think the fundamentals for Kinross deserved anything more than a $4.50 price. That was the maximum amount that people were willing to pay for 6 weeks. They also didn't believe that it should go anything lower than whatever that is, 360 or so. So it established a minimum and a maximum value for the fundamentals of the company. Now, what do you think would make people pay more, like happened right there? The reason people are willing to pay more than a resistance price is because they find a fundamental reason to pay more, right? So on this particular day, when it broke through resistance, the market was telling us that someone found a fundamental reason to pay a higher price. And I have a tool that will scan the market looking for things like this. Situations when the stock breaks through resistance and does many other things. We'll talk about those later. So the reason that happened with Kinross is because gold prices went up. All right, so obviously if gold prices go up, Kinross Gold is going to make more money. Therefore, their company is more valuable. And that is why people were willing to pay a higher price back in early April. And in fact, if we draw this pattern the way it should be drawn, this is something called a pennant pattern. You can draw the line like this. And this was actually the critical day when the market said, based on what we know about this company, we have found a reason to pay a higher price. And they bought the stock aggressively to the upside. And that was our signal that this stock should be bought. And look what happened after that. It made a very strong gain. All right, so that's support and resistance. Now, let's now talk about optimism and pessimism. Okay, optimism is basically the buyers are happy. Pessimism is the sellers are happy. The sellers are more aggressive in a pessimistic market, and the buyers are more aggressive in an optimistic market. How do you know if buyers are more aggressive? Well, you've got rising bottoms on a chart. So if we go back to our inflection point concept and look at the inflection point lows, you can see that for Kinross, since the middle of January, the buyers have been in control. How do I know that? Because every time there is a new inflection point bottom, it is higher than the previous one. What that means is that when the sellers are pushing price down, like they did here for a couple of weeks, they can't push it as low as the last time they pushed price down. And here we get a little bit of a downward movement for only about 4 days, but they can't push the stock lower than they did the last time they pushed price down. So these rising bottoms on the chart tell us that we have optimism. Now, how do you think we're going to find pessimism? Well, pessimism occurs when the tops on the chart are falling over time. Now there's not a lot of pessimism in this chart, but this top is a little higher than this one, which was a little higher than this one, which was a little higher than this one. And so during this period here, we had falling tops, which meant that the sellers were in control, that the market was pessimistic. Now, again, it wasn't strongly so. If we took this stock back a lot longer, you would see that there was, number of years when we had pessimism in the gold mining stocks, but that's been changing in the last 6 or 8 months. Okay. So hopefully you understand optimism and pessimism. Optimism, rising bottoms. Pessimism, falling tops. Pretty simple. Again, if you can just start with your inflection points and ask yourself, are they rising from left to right or are they falling from left to right? You can then determine or understand whether the market is optimistic or pessimistic. Now, the fifth concept is price volatility. So let me explain that one. Price volatility is how much is price changing over time. So because we're looking at a daily chart, we would say how much is price changing day by day. Here, we've got a lot of price change day by day, right? Here, we don't. In this period, price is moving sideways. The market is basically saying that this stock is worth right around $2.75 a share. It might go down to $2.50, it might go up to $2.90, but it's in a pretty narrow range. So here we have low price volatility. Here, price is changing day by day by day. You can see it quickly moving up. Therefore, at this point, we have high price volatility. Now, why is that important? Well, the reason it's important is because how volatile a stock's price is tells us something about the confidence that investors have in the price that the market has given it. When a stock is trading in a narrow sideways range, it means that investors really agree on what that stock is worth. All right, so if we are in a narrow sideways range, like we had right here, then the buyers and sellers agree about what the company is worth. When we are in a period of trending price action, like we saw there, buyers and sellers do not agree on what that stock is worth. Stock is changing quickly over time. All right, so here, low volatility means confidence. Here, high volatility means uncertainty. One of the easiest ways to make money in the market is to buy situations when stocks move from low volatility to high volatility. Notice that this stock was pretty boring for a number of months here in a pretty narrow sideways range and then broke out of that range with some volatility. And here again, low volatility. And then right here on this day, it broke out of that volatility and that started that upward trend. So that leads me to the final element of chart patterns and by far the most important, and that is abnormal activity. Now, why is abnormal activity important? It's the clue that investors have found some new fundamentals that justify paying a higher price. If everyone agrees that the stock is worth, in this case, $4 to $4.25 a share, and then one day a group of investors say, well, actually, we have some information, some fundamentals that makes us willing to pay $4.50 a share, the market's telling you something. The market is telling you that there is some new information that justifies paying a higher price. And because the stock market isn't fair, because some people get better information than others, when things like this happen, it's usually because the people who follow the company the closest know that there is a fundamental reason to pay a higher price. And so when you get moves out of low volatility with some abnormal activity, like happens there, you often get strong trends out of that. All right. I will tell you that I've done a little bit of a study. I would say that 90% of market-beating trends, so trends when price really goes up consistently over time, 90% of them start their trend with abnormal activity. And in fact, you can see on this chart that the times when the stock did well, when it went up, it started with abnormal activity. There was an abnormal price move with abnormal volume. There was an abnormal price move. And they were also both after a period of low volatility. And in this case, there was also optimism. We had a breakthrough resistance from optimism, from low volatility. All of the things that we like to see all occurred there. Now, what is abnormal activity? It is price change that is greater than we would expect. Look at how tall the candle was on this day compared to the candles before it. Everyone hopefully can see that the price change on that particular day was much bigger than normal. The same can be said back here. The price change on those 2 days was much bigger than the piddly price change that had been happening before. So if I can use a metaphor of a big room full of 100 people, if everybody is in that room and they're whispering, you don't have a lot of noise, right? This is a quiet room. When you have a quiet room, there's not a lot of price volatility. If one person in that room screams fire as loud as they can, that's the abnormal activity. It stands out. It is easy to see. So when you're judging abnormal activity, look for big price gains after a period of low volatility, because that's the market screaming at you that there is some new fundamentals that justify paying a higher price. Now we can apply that to the longer term time frame as well. So here's the long-term time frame of Kinross. Let's begin with our inflection points. Okay, so I'm just making little tick marks wherever there was a peak or a valley, right? If I draw a line across the inflection points, I can see that the market was in a downward trend there. I can see that the bottom started to rise here. I have abnormal activity there after a lengthy period of sideways trading. I broke the pessimism. I broke resistance at the trend line. I did so from a rising bottom, and that started the upward trend for Kinross. Maybe I didn't buy the low. I don't try to buy the low. I bought it at 325. Well, I didn't actually buy Kinross, but the signal was there at 325. And from 325 to today's price at 725, that's more than a double. And you didn't have to know anything about Kinross. You didn't have to know anything about gold. You just had to know how to read a chart. And to read a chart, all you have to do is start with inflection points, draw lines across them, and determine whether there is optimism or pessimism, where support and resistance are, is there abnormal activity after a period of low price volatility. Okay? Now, I'm just going to address a couple questions that have been asked. One question is, do you draw the trend line on the top of the wick or the candle only? So I'll just erase some lines here just to explain what wicks and candles are. So these are all called candles, these things, and the wick is the little part on the top. Now, to answer your question, the general answer is that trading or charting and drawing trend lines and all these lines is an art, not a science. Don't worry too much about whether it cuts across candles or not. You want to find the line that best fits as many inflection points as possible. And if that means you get a little wick through it, or that means you get one period when it doesn't quite touch the line, that doesn't matter. You're trying to look for a general idea of where you should draw those lines. You know, if I was drawing support here, I would put support there. And I tend to favor the bodies of the candles as opposed to the wicks. So hopefully that answers your question. How do I buy into volatility? Well, I buy into volatility when there is a break from low volatility. And I'll elaborate on that a little bit more. Being asked, does my chart analysis work with ETFs? Absolutely. I trade ETFs often. And you can do the same analysis with ETFs. You can do the same analysis with anything that you can chart. All right, so we'll come back to questions later. I just wanted to do a quick bit of answering there. But I would ask, for the most part, if you have stock questions or something, save that till the end, because that's when we're going to address them. If you ask me now, my window that shows all these questions, it just scrolls up, so I'll miss them. So hold off on your questions until I ask for them, in terms of stocks anyways. One other question, does it work with juiced ETFs? Juiced ETFs are leveraged ETFs, and absolutely it works. But you have to take a shorter term outlook with those. So I was trading the leveraged ETFs on the gold mining stocks last week, Dust and Nugget, DUST, NUGT, and great profits on those from the action last week. All right, so how do we put it all together? Well, a simple formula for picking winning stocks is to look for stocks breaking through resistance, from low price volatility, from optimism, with abnormal activity. That is not the only formula. We can use these 6 concepts and combine them in different ways to have different strategies. So this would be one particular strategy, is buying stocks breaking through resistance, from low price volatility, from optimism, from abnormal activity. As a trader, I've got a dozen different strategies, maybe even more, that I trade with every day. This is one of them, and if you want more of them, I can teach you more of them. I'm just going to focus on this concept today. So first of all, when did we have a breakthrough resistance? Well, we had a couple on this chart. I'm going to focus on this one here because it's the easiest to see. So there's my line of resistance. I've drawn that basically across as many of the little tops as I could establish a line for. I can also see that I have optimism because this bottom is higher than this bottom, right? So I have rising bottoms. I had a breakthrough resistance right here. The height of that candle on that day was abnormal. The market had been trading sideways for almost 2 months, so I knew that I had low price volatility. So all of my items are there. I've got my breakthrough resistance right here. I've got my break from low price volatility right there. I've got optimism, rising bottom, and I've got abnormal activity. All right. So that would be one example where you would buy this stock because it had that formula satisfied. Buy it at 450. Today it's at almost 750. So it's had a nice little move there. Now we can do that in a longer term time frame as well. And we can use things like trend lines to define resistance. It doesn't always have to be a horizontal line. It can also be a trend line like that. So there we've got a breakthrough resistance from optimism, from sideways trading, low volatility, with abnormal activity. Look at the height of that price action for that week. That move up in price on that particular week, which was the first week of February, was a bigger move up than this stock had made any time in 3 years. And it traded more volume on that particular week than any time going back to the spring of 2014. So we had all of our things satisfied. We had a breakthrough resistance. We had optimism. We had low volatility. We had abnormal activity breaking through resistance. And at that point, at 325, we had a signal on the weekly chart that Kinross was more likely to go higher than lower. And in 1, 2, 3 months, it has doubled in price. We beat the market by using charts without knowing anything about what this particular company does. Doesn't matter. The market knows that. All of the people trading this stock every day know everything about the company. I don't have to read up on what this company does. I don't have to study the fundamentals because investors are doing that for me. I just have to follow what they do. Okay? Now, time frame confirmation. What does that mean? Well, if you want to be a really good trader, you can put another little tool in your arsenal, which is this concept of time frame confirmation. I like to use the longer term time frame to tell me what to do and the shorter term time frame to tell me when to do it. So going back to Kinross, the longer term time frame is the weekly chart. Okay, this is a weekly chart going back 3 years. At the start of February, it told me that this stock was likely to go higher. So the longer term time frame was telling me what to do, buy Kinross. But if I go to the shorter term time frame, I can pick the specific day to buy Kinross, which was right here when this line of resistance was broken. We had abnormal activity. Look at the volume on that day. We had the market yelling at us that something was going on. We had abnormal volume, abnormal price. We had another signal to buy on the daily chart right there when we had the abnormal price movement, from optimism through resistance, from low volatility. So that's one of the things I like to do is anytime I'm looking at buying a stock, whether I'm day trading it, whether I'm long-term investing in it, is I look for time frame confirmation. All right. And you can do that on Stockscores very easily. I'm going to show you some things on Stockscores in a moment where you can do that. Now, I'm going to take your stock questions in a moment, and we'll analyze a few stocks. So if you want, you can pose a question to me. You can pose a symbol. I won't get to all of them because there's so many people in this webinar today that I can't possibly do all of them, but I'll try to pick a few and just to drive home some of the concepts that we've talked about. While I'm waiting for those to come in, I'll just give you a quick overview of some of the tools on Stockscores. The Stockscores Education Center is where you can learn more about how to do this. So I'm jumping into the Stockscores website right now. I can go to the market scan, or sorry, not the market scan tool, into education here, and you can see that we've created all of these lessons and strategies for investors to learn my approach. So what we did today were the 6 elements of chart patterns. Okay, and it was a quick version of the 6 element of chart patterns. I didn't go into all the nuances of it, but basically the concept is there. So if you have access to this, and you have to pay for access to this, you can read a lesson. So I can click on the lesson icon, and I can read all about chart patterns. Okay, there's the concept of inflection point, which is what we talked about today. I can then watch a video. Okay, so you can watch this on your cell phone, on your computer, watch a little video that has me explaining the 6 elements of chart patterns concept. Then, once you've done that, you can do an assignment. So you can make sure that you understand the concepts that I've taught you in that video. So there's a little assignment there along with the answer to the assignment. And then finally, there is a multiple choice test to make sure that you really did understand what I was teaching you in that particular lesson. So that's the foundation. That teaches you the theory of how I do what I do. Okay? And you can see there's quite a few lessons in the foundation. Then once you have that, you're ready to start learning my strategies. So if you want to know when to sell a stock as a position trade, you can do that particular lesson. There's a lesson and a video. And I've also got 4 of my position trading strategies here. If you want to be more active as a trader, you want to day trade or swing trade, well, I've got a number of videos and lessons on how to do that as well. So these are my specific rules for when I buy and sell. So when I traded the market last week, I traded the gold ETFs, I traded Apple, I traded Yelp, I traded, it was actually a quiet week last week. I'm trying to think if I traded anything else. Those were the main ones. I probably traded a couple more, but I don't recall. Anyway, I did all that trading using the concepts that are taught in this area. So that's the Stockscores Education Center. And we have, as I said, Getting Started, which are free video lessons, the Foundation, which you have to pay for, Investor, which you have to pay for, and Active Trader, which you have to pay for. I'll touch on this in just a moment. The way you work through the material is a lot of people read my introductory book, The Mindless Investor. You then do the Foundation to learn the theory, and then you do the Active Trader strategies or the investor strategies, depending on how you want to trade the market. Do you want to be a day trader and sit in front of a screen and make a living trading the market? Well, then you're going to focus on Active Trader. Do you want to just grow your retirement portfolio quicker than your neighbor? Then you're going to focus on the investor material. Okay, as I said, all of the Education Center in the Foundation has a written, video, assignment, and test. And in the strategy, it just has the written and the video because the ultimate application is in your actual trading that you will do. All right, I've got a little bit of online training coming up. What I do is I complement the stuff that you see on Stockscores with some live trading or training, and trading actually. So that all starts at the start of June. Saturday, June 4th, I'm going to do a live class, the same as what I'm doing this morning, from 9 till 12, so not as much longer than what we're doing today, and I will teach the theory. And then the following week, every night for an hour, maybe an hour and a half, we're going to actually look for opportunities using the Stockscores market scan tool. So here's the market scan. I can select a strategy. So if I'm looking for a position trade on the Canadian market, I might run the Stockscores Simple Canada strategy. I run the report. I have 45 charts to look at. I'm doing this very quickly because my purpose of today's presentation isn't so much this. I'll do it in another webinar later this month. But anyway, and what I do is I cycle through these charts looking for the kinds of patterns that make up these particular strategy entry points. So this isn't one that I would buy now, but 3 days ago it gave a buy signal because it broke through resistance from optimism. It had rising bottoms with abnormal activity through resistance. So it had everything that I want. 3 days ago that price was at $2. Today it's at $2.35, $2.30. So it's gained 15% from my signal 2 days ago. And how did I find that? Using this tool, the market scan. So what we're going to do in June during this live trading or training is each evening we're going to do these scans together so I can teach you the strategies with specific examples. So real market conditions, not woulda, coulda, shoulda, what I did 9 months ago. Real market conditions showing you what I do. For those who do the active trader course, from Monday to Thursday for the first couple of hours each day, you can watch me trade the market, day trading and swing trading. I only do the first couple of hours of the day because it's when most of the action happens. And so in terms of a learning experience, you can get all the value you need out of it in the first couple of hours of the day. All right. So anyone who registers for these courses before the end of May gets that live training for free. I'm not going to touch too much more on these courses. I'll do that later in the month. I didn't want to make this a big sales pitch today. But if you want more information on that, there is the address to go to, stockscores.com/learn. And before I answer questions, what I will do is just put up a quick poll here. If you want me to send you an email with some more information about those upcoming classes, just answer yes to this poll and we'll send you an email. I won't send you a bunch of garbage. I don't spam people. I hate spam myself. I won't phone you or bug you or anything like that. It's just, 1 or 2 emails in the next month that will give you some information on that upcoming class. If you want information on it, say yes. If you don't, say no, and I won't send you anything. Now, if you are one of my past students, let's say you took my course, a year ago and you want to just have a refresher, you can redo the live training in June for $195. Whoops. So just say yes to the poll. I know I've got a lot of my old students on here always looking to update their learning. You can do all that there. The email information is not going to come out tomorrow. It'll come out later in May. I've got a whole bunch more webinars this month. If you go to the Stockscores website, you can see links to those webinars. And I'll be teaching different things in each webinar, and I'll elaborate more on what these courses entail at the end of May going into June. All right, if you have any questions for me, there's my email address. And again, there's the address where you can watch videos that explain what the active trader course is all about, what the investor course is all about. Go to stockscores.com/learn and you can watch those at your leisure. All right, let's answer some questions. So what I'm going to do now is jump over to the Stockscores website. And for those that haven't used Stockscores in the past, the way you enter a symbol is up in the top right of the screen. So if I want to pull up, let's see, what's a question here? Someone's asking me about Apple. So let's pull up Apple. So I just typed in the symbol in the top right-hand corner up here, AAPL, where it says Get the Stockscores. Clicked on Go, and here I have a chart of Apple. This is a 240-day, so 8-month daily chart. And you can see that Apple's been pretty beat up over the last 3 weeks or so. That all came on the heels of bad earnings announcements and then Carl Icahn saying he moved out of the stock. All of those things contributed to the weakness. Now, the first thing I'm going to get you guys to do is try and think about where support is on this chart. Where is the real significant floor price that this stock has hit in the last little while? Oh, you don't see the poll. Sorry. I will just pause for a second. I'm going to take the poll down. I have my apologies. I got to stop the poll. How do I do that? Okay, so we're going to close the poll now. And in just a moment, you should see my screen again. Then I can continue my talk. Come on here. There we go. Anyway, for everyone that voted in the poll, thank you. And you should see the screen change in a minute. Sometimes there's a little bit of a delay between when I do it. There we go. Chart's back up. All right. So there's your little bit of work to do right now. I want you to tell me, you don't have to tell me, I want you to tell yourself in your head, where is support on this chart? And the way you do that is you look for the major price levels where price stopped going down and started going up. And I would say it's at $92 a share. Everyone see that back in late January, it just about hit 92. You know, it was maybe a little above 92. 92.50 perhaps. Unfortunately, I can't draw on these charts the way I was drawing before when I was doing my presentation. So just, you know, sort of see that there was, get my mouse back over here. There we go. There was support right in there at 92. So I bought Apple last Friday. I bought a little bit and then I added to it on Monday. And I added, I think, a bit more on Tuesday. And then I sold it all Wednesday morning on the open actually. So, you know, I was buying it around 93.50 or so. Why? Because the market had fallen sharply into support on Apple. And I just know that when markets fall into support, they usually bounce. And we got the bounce mostly on Tuesday. Wednesday, it looked like at the open it was going to go up some more. Actually, I can show you how it behaved through the week here. So this was Monday. I bought some, I think, in here, and I added to it here. And then I sold it all right at the open on Wednesday because it started to move down from the open. It wasn't showing the strength anymore. And I know that these things, these little bounces tend to last 3 days. And so I took my profit, made a few $1,000 just flipping in and out of Apple very quickly. That's called a swing trade, in and out very quickly. Now, Apple has since been falling back again, and it's now back to support again. So will it bounce? Well, the second time it hits support, it has less of a chance of bouncing than the first time. So I'm not buying Apple on this move just yet because I want to see a break of this downward trend line. And again, I can't draw in here like I was before, but if you can imagine a line drawn across those tops on this intraday chart, I'm looking for a break of that line as a cue to maybe buy some Apple next week. I'll watch it closely. I didn't do any trades on Apple last week. All right, another chart, and I've got all these other questions here, so I got to slide my monitor up here. Hold on a moment. Okay, so Costco. Symbol of Costco is COST, trades in the U.S. market. And we can look at Canadian stocks as well. I know many of you here today are Canadian. So, but let's do the analysis on Costco. I'm going to do a 3-year chart here. Remember I said you can change time frames and you should do your analysis on multiple time frames. So I have these little links at the top of my chart where I can change the time frame. If I want to look at what happened over the last 10 days, I click on the 10-day time frame and I can see that the sellers are in control, that there is pessimism in Costco right now. How do I know that? Because the tops are falling over time. And I can also see that my stock scores are low. They're red. Okay, they're 30 for the sentiment score. So in the short-term time frame, it doesn't look very good. If I look at a 3-year time frame, well, here I can see that I've got rising bottoms and I'm falling into support at the upward trend line. There is, however, a little problem, and that is I've got a falling top here from the previous high. So I would rate Costco neutral right now. The long-term momentum is up. That's a positive. But it's been weak for the last 6 months. For the last 6 months it's been weak, which is why the stock scores have been poor the last 6 months. I do think there's a good chance it will bounce up off of 145. But I think the upside is limited. And so to me, this isn't a stock I would buy right now. If I owned it, and I don't own it, but if I did, I would probably be looking to, you know, maybe a little bit of upside. Maybe it goes up to 152 to 155 in the near term. You can flip out of it there. But I think I'd be looking to sell this sometime soon because the chart does definitely look to be losing its momentum. Okay, CDZ on Toronto. Let's take a look at that. T.CD. So Toronto market stock, I have to put a T dot in front of the symbol. This is an ETF representing dividend stocks on the TSX. The buyers are in control. We have optimism. Coming into a lot of resistance over here. So I think it's going to get stuck in the short term. Let's take a look at the 3-year chart. It basically looks the same as the chart of the TSX 60 ETF, which is T.XIU. I think it's had a nice little bounce back run, probably losing some steam in that upward move. I think it's more likely to go sideways or maybe even lower in the near term. So I don't think I'd be buying it here, and I'd be thinking about selling it. Doesn't look terrible. You can see the stock score is still 62. It just looks like it's running out of momentum, and it's going to be a bit of a stall in the upward trend in the next little while. All right, another stock, RPRX. And I'm sorry, I won't be able to get to everyone's question, but I'll try my best to do as many as I can. RPRX had a big abnormal move here. Popped. It's now in what's called a flag pattern. What you want to watch for is this downward trend to get broken. The fact that it traded very abnormally about a month ago is a positive for the stock. It wasn't quite a month ago. But the fact it's drifting lower shows that the buyers have lost their enthusiasm. You want to see a sign of enthusiasm. So you want to see this downward trend that's been underway get broken. And if that happens, then I would consider it. But right now, I just think it's a hot stock that's kind of losing its allure. So I don't see any reason to buy it today, but that could change Monday. Let's take a look at an energy stock, T.BNE, which is Bonterra Energy. Bonterra Energy, buyers are in control. We have optimism. We have rising bottoms on the chart. That's good. We had a little flag break on Friday, bouncing off of the upward trend line. That is good. Looking at the longer term time frame, I like it. I think longer term it's good. I think it's more likely to go to $35, $40 than it is to go to 15. The only issue I have with it is it's already made a pretty good run in the last few weeks. Last 4 weeks it's done quite well. And so it's more risky to enter here. Is it bad to enter here? No, I would give this one a 7 out of 10. If you're a longer term investor, I think it's a 7 out of 10. Just don't be surprised if it maybe goes down to 23 before going to that $35 mark. There's no guarantee it'll go to 35, folks. I mean, this is, just the analysis looks like it's more likely to go higher than lower. I think if you own it, great hold, stick with it. If you're looking to buy it, it's okay. It's not outstanding. Okay, I'll do 3 more. Next one is Potash Corp, T.POT. Who's in control of this one, buyers or sellers? It's always one of the questions I ask. And the answer is sellers because we have falling tops. Everyone see that there's no rising bottoms on this chart? Stock scores are ugly, 21, pretty bad. It is, however, at some support. See how it's kind of bounced off of 20.5 a few times? So I do think it could bounce in the near term, but there's no optimism there yet. So until it starts building a rising bottom, I wouldn't consider buying it. Now looking at the 3-year time frame, yeah, I mean, it's ugly. This thing has been in a downward trend for over a year, and you can see that for over a year, the sentiment stock score, this line here, has been below 60. That's the critical point. It was above 60 at the beginning of 2015 when it was moving up, but then the trend was broken. We've been in a downtrend ever since, and that's why those stock scores have been below 50. If you go into the Getting Started area of stock scores, in the education area, go to Getting Started. There's a video in here called the Stock Scores Indicators, and you can watch this video and it explains how to use those stock scores indicators. It doesn't cost anything to do that. So if you're wondering what my stock scores are all about and how you can use them to pick stocks, that's the video to watch. All right, so I said I would do 3 more, so we got 2 more to go. Let's take a look at, let's try Gold Corp, so T.G. Gold Corp trades in the US and Canada. On the New York Stock Exchange, the symbol is GG. On the Canadian exchange, it's T.G. And I like it. I think it's more likely to go higher than lower. It's actually been underperforming some of the other gold miners, so A lot of the gold miners have done far better than Goldcorp has. It's been a bit of a laggard. However, you can see that here, hopefully you see my mouse circling the chart there, right at the end of April, it broke through resistance from optimism, from low volatility, with abnormal price action. So all of the signs were there roughly 6 or 7 days ago to buy Goldcorp, just under $24. Now it's just under $25, so maybe it's up 5% so far. But let's take a look at the longer term time frame. Let's go 3-year. And there we see a little bit of an issue actually. Its upside is a little bit limited because if I was to draw a line across these inflection point highs, that line, if I extrapolated it, is going to give it some resistance right around $28 a share. So the upside is a little bit limited here. And for that reason, I'm not so sure I would buy it actually. Because although it looks like it's probably going to move higher, its upside is limited to somewhere around $28 a share. I just don't know that it has enough reward potential for the risk you have to take to buy it. If you already own it, I would stick with it, but I don't think I'd buy it there. Now, I'm just going to take a look at Barrick, which is another oil company. See how this one has performed so much better? All right, this is also another big gold mining company, but they have other things as well. But look, in the start of January is when it broke through resistance from optimism, from low volatility, with abnormal activity. My sentiment stock score, which is the green line, was above 60. My signal stock score spiked up above 80. That's how you use these stock scores indicators. That was when the stock was at $12.50. It's now at $24. So it's far exceeded what Goldcorp has done. I wouldn't buy Barrick here, but if you own it, I would stick with it. And it's just been a great mover, for a large cap stock. It's done really well. All right, one more, and then actually, you know what I'm going to do? I'm going to do one more stock, and then I'm going to do the indexes for you. Let's do PLI. So just to get out of the commodity space a little bit. All right, so this is Prometic Life Sciences, Canadian market. We have rising bottoms. We have optimism. We have strong resistance here at about $35 a share. Kind of got beat up on Thursday, but hasn't broken the cycle of rising bottoms yet. I don't like what happened on Thursday, but let's take a look at the longer term time frame. On a longer term time frame, yeah, I think what's happened here is it's been a real strong stock for a long time. It's hitting resistance. Look how many times it's hit $3.50. Once, twice, 3 times, 4 times, and it just can't seem to break through that threshold. So investors are telling us that based on all of the information they have about this company's fundamentals, they don't want to pay more than $3.50 a share. It's tried, 5 times in the last 6 months to break through that threshold, and it hasn't been able to. So I would lean towards being a seller on this stock. I think you could see it pull back into the 240 range even. And then maybe at 240 it bounces and starts to make another run up towards 3.5. But for now, I just don't like the risk reward of buying it here, and I think you would want to watch it closely for a signal to sell. Someone's telling me that they have new shares coming out, so that they're doing a financing, I assume, which is going to be dilutive. That's what these companies do. Their stock price goes up, they do a financing, put some cash in the bank, it dilutes shareholders, and that's often why you get pullback. So that's some good information. I didn't know that until somebody just wrote it to me in my question box. However, the market told me that something was wrong, and that's probably why it gapped down on Thursday. So if we go look at Thursday's price action, I would almost guarantee you that there was some negative news, and it could be that was the announcement, and that's what happens. People get mad because they're being diluted, and share prices drop. I'm just going to quickly analyze the TSX. This is a good chart, not a great chart because it's coming into resistance, but the TSX SX, the Toronto Stock Exchange, has had a good little run. I think it probably goes sideways near term. Let's do the NASDAQ 100, which is, American tech stocks. Been pulling back over the last couple of weeks. I actually think it'll bounce back next week and start to move back up again. That could be helpful for some of those beat up stocks like Apple, the big name stocks, Netflix, Facebook. They're not all listed on NASDAQ, but they're kind of that tech market. The Dow Industrial Average, the Dow 30, better chart than the NASDAQ 100. Looks also like it will move up short term, but it's going to get stuck in around the 180, which is about 18,000 on the Dow. So not a lot of upside potential. I talked about that on Money Talks Radio today. Let's just take a look at energy. Take a look at the oil market. USO is the ETF. It's got this upward rising bottoms. It's optimistic, but the bottoms are rising quicker than the tops, and that's a sign that the buyers are losing their enthusiasm. So I think oil looks okay, but it's more a market that's bottomed as opposed to one that looks like it's really going to rock and roll to the upside. That could change. Right now, I just don't see any excitement in the oil market, and so it's a hold, not a screaming buy yet. Again, that could change Monday. I mean, news of this Saudi finance minister being fired, that could be a catalyst. Who knows? We'll see if that generates some interest in the oil market next week. Finally, I'll do gold. Let's take a look at the 3-year chart of gold. Here's why I like gold, because it broke its downward trend line at the start of the year. It built a rising bottom, and now it's breaking from a rising bottom. That is a classic turnaround pattern. It has lots of pessimism to work through still, but it does look to me like gold is more likely to move higher than lower in the months ahead. In the weeks ahead, maybe not, because it's had a pretty good jump last 2 weeks, and so it may see some profit taking in the short term, but longer term, I do like gold. Now, that analysis that I just did is what I call my market minutes analysis. Every week, I do a free video. If you go to the Stockscores website, at the bottom right, there is a video where I do that analysis for you each weekend, and it's free. I've just finished my analysis for this week. I haven't updated my link here yet, but I'll do that after the webinar. So that's another thing that you can get from Stockscores that hopefully helps you learn some of this stuff. I'm going to wrap up my presentation now. It's been over an hour. I said it was going to take 45 minutes to an hour, but obviously a lot of information to cover. So if you have questions for me, there's my email address. I really encourage you to follow me on Twitter because I put out a lot of comments through the week on where I think markets are going, trades that I'm making. I told people I bought Apple on Twitter. I told people that I bought the DUST ETF. Things like that I throw out there on Twitter once in a while, and it's just, you know, free little tidbits of information that you can get. So there's my Twitter handle at Stockscores. There's my YouTube channel as well. Lots of free videos on YouTube that I've done over the years. youtube.com/stockscores.com spelled out. And subscribe to me on YouTube. Follow me on Twitter. Those things make me want to do more and more of this information. I want to thank you all for joining me today. Just a quick reminder that we've got lots more webinars coming up this month. So if you go to the Stockscores homepage, there's a list there of the upcoming webinars. If you click on this link here, you can see the topic. And I've got how to grow your retirement portfolio, how to make stock trading a career, how to get the most out of Stockscores.com, 3 strategies for profiting in the stock market. That's 2 weeks from now. How to trade stocks with the Stockscores approach. That's next weekend on Saturday. I'll actually be doing that one from Las Vegas, where I'll be hanging out for the weekend. So all free to attend. Join them. I think you're going to learn lots. I hope that you enjoyed today's presentation. I want to thank you all for joining me. And as I like to say, trade well. Thanks, everyone.